Welcome to a new edition of a chat with Daman Asset Management Team. After 7 consecutive months of gains, global equities dropped during the month of September, with MSCI All Country World Index falling 4.3%. Catalysts for the sell-off range from supply chain worries, rising inflation, more hawkish Fed, sharp rise in US Treasury yields, and China Evergrande situation. On the fixed income side, the performance was not better. The Bloomberg Barclays Emerging Market US Aggregate Total Return Index dropped 122 basis points, with spreads overall moving beyond 360 basis points. Fed tapering, inflation, energy prices, supply chain pressures, and China property issues will remain the dominant factors driving investor sentiment for the next quarter. In addition, we're expecting more volatility in the markets. We continue to stay overweight on equities versus fixed income. However, we would like to stay well diversified and prefer high quality companies with stronger balance sheets. On the fixed income side, we see it too early to add back a lot of risk, and we suggest to remain more cautious with an overall preference for investment grade over high yield.
During September, the JP Morgan MB Global Diversified widened the most among major indices, while developed market credit held better, particularly the US high-grade credit having tightened 1 basis point over the same period. Notably, the high yield component of the MB and the SMB widened by 50 and 62 basis points respectively, compared to just 17 basis points for the US high yield index. The MB Global Diversified yield has steadily risen given the combination of higher US Treasury yields and wider spread. We do not see valuation as being cheap enough, and with challenging fundamentals, factors such as US Treasury real yield and weaker EM effects are here to persist over the coming periods. Additionally, downside risks are here to remain, with clearly China being the top risk. We see it as too early to add back high yield position. With all the factors I just mentioned not really improving, we remain cautious and we overall have a preference for investment grade over high yield. We remain constructive on emerging markets despite the confluence of global risk amid compelling valuations. And to sum up our view, we maintain a long oil exposure with MENA sovereign, but we favor Mexico and Colombia. To stay in Latin America, we add Panama to our likes and we remain cautious on Peru. In EM Asia investment grade, we would prefer Philippines over Malaysia, and we still prefer the Indonesian quasi-sovereign complex to the sovereign curve.
In September, we saw a hawkish Fed causing an upward capitulation in the US 10-year treasuries in the higher end of 1.5 to 1.6 handle. Additionally, we also saw increasing concerns about higher energy prices juxtaposed with supply chain driven inflation weighing on growth and causing persistent inflation. We remain cognizant that any significant variation in the key non-farm payroll numbers, which are expected in the first 10 days of October, in either direction can be market moving. And in line on a stronger set of data will set the path for the FOMC to announce an official start to the tapering at the conclusion of the next FOMC meeting, in our view, in November 3rd. Either way, if the numbers are weaker, we think that FOMC will require more deliberation with respect to the trajectory of tapering. Now, when we start focusing on the single B credits in the past few weeks, we have seen a large diversion, especially among the long end of the bonds. Now, let's start region by region. In the MENA high yield space, we prefer Bahrain, which is cheap on the technical basis in our view across the belly of the curve, while Egypt is cheap across the long end, given our cautiousness, general cautiousness on the EM credit. We feel it's too soon to turn bullish on Egypt due to its high beta nature. We are definitely going to align ourselves and look for the right entry points for Egypt on a technical basis and a tactical basis when the time is right. Moving over to Asia high yield, we continue to favor Pakistan, as technically there remains room for upside, still room for upside, while adding Bangladesh to a watch list for a probable, in our view, future allocation if it does indeed issue the first dollar-denominated bond, sovereign bond. Now, we view this as interesting because a low single-digit current account deficit and fiscal deficit in tandem with a sustained real GDP growth of around 6 to 7%, FX reserves worth close to 9 months of import cover, which is $48 billion, makes it a rather compelling story in our view. Finally, when we move over to Africa, we can touch upon Egypt again, which issued a second tranche of US dollar denominated Eurobonds worth $3 billion. This is the second time they're returning to the market after tapping the market in close to $3.8 billion in February earlier this year. This is adding more depth to the curve. This was again a multi-tranche issue, which was broken down into 6 years, 12 years, and 30 years, whereas the former was 5 years, 10 years, and 40 years. Finally, the countries that we do prefer in the remaining part of sub-Saharan Africa are Angola and Ghana, which we still feel is technically very attractive, whereas the two countries that we have favored in the last 6 months, Ivory Coast and Gabon, have outperformed, and we like to move to underweight.
We believe in fourth quarter 2021, Fed tapering, rising energy prices, supply chain pressures, and China property issues will remain the dominant factors driving investor sentiment and market volatility. With inflation remaining high and COVID cases on a decline in US, investors broadly expect the Fed to announce tapering by the end of 2021. We believe Chinese regional authorities would contain the Evergrande debt issue to avert a contagion, as property sector contributes about 28% to the country's GDP. However, due to this, we would not rule out a slowdown in the Chinese property sector and economic growth. We are cautious in the near term owing to rising energy prices expected to feed into the headline inflation and supply chain issues constraining growth. However, with COVID cases trending down globally and vaccination rates improving, we expect supply chain pressures to gradually subside on an improvement in labor shortages and production, and global economy to gradually regain its lost momentum on a strong pent-up demand. Therefore, we continue to see an upside case for equities and stay overweight on equities. Within our view on the economy regaining momentum, we prefer to tilt towards cyclical sectors. However, given the near-term inflation concerns, we choose to incline our cyclical exposure towards commodity-linked equities, which will provide a strong inflation hedge, and overall equities exposure towards companies with a strong pricing power. Banks will also be a beneficiary of any upward moving yields. We are neutral on US, given the index is dominated by growth equities on which downward pressure can continue from any further rise in yields. We keep our overweight on Europe, given its valuation discount versus US and cyclical tilt. We maintain our neutral stance on EMs. Within EM, we like an exposure to countries with strong foreign reserves, low external debt, and manageable current and fiscal deficits, as rising yield in US and higher global inflation can cause strong currency headwinds. We like an exposure to South Korea, Taiwan, and India in Asia, Saudi, UAE, and Qatar in MENA, Russia in Eastern Europe, and Mexico in LATAM. Strong year-on-year rise in energy prices should underpin GCC, Russian, and Mexican equities. Given the strong energy prices, high vaccination rates, and PMI data demonstrating strong expansion, we expect GCC economies to do well, with most of the major economies reporting fiscal and current account surpluses. We continue to avoid an exposure to Turkey and Pakistan and remain cautious on Egypt, as higher yields in US and rising energy prices can create strong currency headwinds for these countries. We reinitiated a position in Adlong distribution and augmented our exposure in Yasat, as the recent sell-off in these names had exposed a significant value. Both these stocks offer a compelling dividend yield and a robust cash flow visibility. We initiated a position in Saudi Airlines Catering. We see the company to be a direct beneficiaries of Saudi reopening, with the government recently increasing Umrah and Hajj pilgrim capacity. Domestic travel within Saudi has almost reached pre-COVID levels, while international travel continues to improve as the country begins allowing vaccinated expats to return. We have also added to the commodity exposure in the form of Industries Qatar, which is one of the largest regional producers of urea with an input cost advantage over the global peers. We remain bullish on urea prices given a considerable spike in input cost, constrained supply, and robust demand.
Thank you for taking the time and watching another edition of a chat with Daman Asset Management team. You can always contact us on our website and social media platforms. Till the next edition.